This is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. And today Dell reported earnings that were disappointed the street, and of course the street's taking the stock down, somewhere between 9 and 10% the last time I looked. And it really says a lot about what markets and stock prices are really all about. Because when you look at Dell from a long-term perspective, I think you can clearly see that earnings do determine market price. Dell, like a lot of tech stocks, had irrational, exuberant pricing going on during the tech bubble. And then, of course, the price came back to reality. Then, stock price kind of followed earnings for a while. And then earnings have been a little bit erratic since, really since 2006. But Dell was working on a nice recovery. Their price had gone from, somewhere actually got below 8. It was rallied up to 15. But today they missed earnings. They missed, it was a pretty big miss. But they are talking about a upgrade cycle in the, PC several quarters out. So they were kind of upbeat. But yet, of course, the market, took the price down anyway. So Dell, if you look at it from a long-term point of view, they've generated almost 20% earnings growth. Shareholders have been very well rewarded over the long run with a 23.6% compounded rate of return going back since 1996. However, as you can see, since 2005, the last 4 or 5 years, the stock price has really been pummeled as a function of overvaluation plus kind of weak earnings. If you compare Dell to some of its major competitors like Hewlett-Packard, Hewlett-Packard had similar situation. They were irrationally exuberant during the tech bubble. Their earnings went into a slide. Then, of course, they've had a nice recovery going, since the bottom of 2002. And you can see that their stock price is tracking that. They got beat up by the recession, but their earnings are recovering. But, during the same 15-year period that Dell did 20% a year, Hewlett-Packard, generated a single-digit return to their shareholders of about 6%. But yet today, Hewlett-Packard, and more recently, Hewlett-Packard is actually doing quite well. The last one I'm going to show today is IBM. IBM kind of went through some similar situations like Dell. Their earnings growth is similar to Hewlett-Packard more recently. They were overvalued during the irrational exuberant period, but both Hewlett-Packard and IBM are, handling Dell's news pretty well. Their stocks are actually flat to slightly up. If I go back and look at this from a shorter time frame, you can see how much impact this actually, earnings and operating price really have. Dell's earnings have been very flat. Actually, there's been no earnings growth at all since 2005, and of course their stock price has been, constantly sinking. So, over the last almost 5 years, not quite 5 years yet, Dell has lost a compounded 18% a year due to bad earnings, even though they have a great long-term track record. Hewlett-Packard, on the other hand, has had some pretty good earnings growth during this last 6-year period. So, for the shorter period of time, their shareholders now have done extremely well, averaging almost 19%. So clearly, this relationship between earnings and market price, both long and short term, is very, very profound, as well as valuation. IBM has had 13% growth during the last almost 5 years, and their shareholders have generated about a 5.5% rate of return during a time where the market's lost 1.9. But again, you can see that it was slightly overvalued in the beginning here, but it's certainly following earnings, and it's a little undervalued now. But the bottom line is, Dell is not possibly worth 10% less today than it was yesterday. However, in the short run, anything can happen, but in the long run, it's earnings that determine market price. As I hope this little presentation on the tech sector has helped you see that. This is Chuck Carnevale saying thanks for listening, and it's Friday. Y'all have a great weekend. I'll be taking the weekend off, and I'll talk to you again on Monday. Thanks for listening.